right, welcome back everybody to another episode of Who Charted, the most exciting 6 minutes in markets. With me as always is Drew Wells. We're ready to get into it. 6 charts in 6 minutes. You know the drill. Let's get it started.
All right, everybody's getting all bared up on small caps, and I think that that makes sense in a lot of ways. If you look at the chart of the Russell 2000, S&P 600, IWM, pick your poison, trading in that range there for the past year or so. It kind of looks like crap, particularly more worse on the Russell 2000 side. But take a look at this equal weight S&P 600 relative to S&P 600 ratio, right? So the average small cap stock in the S&P 600 has actually been outperforming all year long. It's above that breakout level, breaking out to the upside, above a rising 50-day moving average. And take a look at momentum in the ratio here, remaining firmly in that bullish range right there. So everybody's running around with their hair on fire right now, with a lot of geopolitical news coming out and everything. And in theory, small cap stocks should not be working in that environment. And while the charts themselves look pretty bad, the average stock has been doing pretty well.
All right, certainly a theme over the weekend was the death cross, specifically the death cross in the NASDAQ Composite. Now, this is the entire composite, not just the NASDAQ 100. But what's interesting to me is that we dug into the numbers, and since its inception in 1971, there have been 31 instances of a death cross where the 50-day moving average crosses below the 200-day moving average. Now, the one that we have now currently in play would mark 32. What's interesting is that 3 months out from the signal, from the death cross, your probability of gain for the NASDAQ Composite is actually close to 71%, with a median return of about 7.23%. So the death cross by itself, in isolation, is not as bearish as headlines would have you fear. However, we do think that if you're using it as part of an investment process and a strategy with rules to get back in, it does add value.
All right. Continuing on with that small cap theme, this is small cap consumer staples relative to small caps on the top pane. Bottom pane there, this is large cap consumer staples relative to large caps of the S&P 500. So the interesting thing is that these ratios trade pretty closely together over time. But what's probably most interesting over the last several months here is that small cap consumer staples relative to small caps have actually been making lower highs, while large cap consumer staples have been breaking out and making higher highs over the last several months. And so it's interesting to see that risk on, risk off dynamic play out within small and large caps right now. So large caps have been the winners over the last several months, outperforming small caps. But it's interesting to see that the risk sentiment is certainly shifting here in the cap space as large caps move towards more of a risk off stance and small caps move towards a more risk on stance.
All right, another one that was a hot topic over the weekend and over the past few days of trading has been gold. Gold spot breaking out above that 1880 level, the green line on the chart. I think that this is interesting because it is coinciding with a momentum shift. If you look at the 14-period RSI at the bottom of the chart, you see a series of higher lows and gold now pushing towards an overbought condition. Now, if this trend is really strong, we would expect to see that 1880 level hold while momentum kind of works off the overbought condition and then see a continuation higher. I think breaking through 1920 would be the next key level to watch, but gold certainly has to be on the radar here as a reversal up and out of the consolidation that's been in place for over a year now.
All right, in our last episode, we hit international pretty hard. I wanted to bring this chart to view here. This is probably one of the most interesting charts in the international space, Latin America, right? In the process of reversing a bearish trend into a bullish trend, right? So we have price above that 26.25 breakout level, above a rising 50-day moving average. Here's what's really interesting within this region here. Take a look at Latin America relative to ACWI ex-US. Again, above that breakout level highlighted in the middle pane, above a rising 50-day moving average of the ratio. And the cherry on top, it's also starting to outperform the S&P 500, again above another breakout level and above rising 50-day moving average. So we have a nice little trifecta of bullish price action working in this region of the world. It's going to be interesting to see how this one plays out.
All right, my last chart is the 10-year note and the 10-year yield. Obviously, they move inversely with each other. But what's interesting is the 10-year note clear bearish trend. This is a weekly chart, so below the 10-week moving average, below the 40-week moving average, right? By all definitions, a downtrend. However, for the past 2 weeks, we have long lower tails. Look at those last 2 candles all the way on the right, long lower tails. So what that tells me is that the bears tried to take control, but they kind of fumbled the ball for the second week in a row. Fumbled the ball on the 2-yard line. So now we'll see if the bulls can kind of regain that 128 level, start to regain the moving averages, and at the same time see if yields move lower. We're not there yet, but I think it's interesting that the bears have not been able to make much progress here over the past couple of weeks, and we've actually seen the bulls strip the ball and try to advance the game in their own right.
All right, everybody, thanks so much for spending some time with us. Don't forget to like and subscribe, and we'll see you in the next video.
Thanks, everyone. See you soon.